afternoon. This is Bloomberg Quint, the top headlines of this hour. Nifty moves back above the mark of 10,100. PSU banks and metals lead the gains. And RB Infra cracks in trade after CBI files a charge sheet against the company in Pune court, and the brokerage firm HSBC downgrades the stock to hold. And Cipla is unfazed by the regulatory hurdles faced by its peers in the US. CEO Umang Vohra tells Bloomberg Quint that he expects a quarter of the pharma company's total sales to come from the US over the next 3 to 5 years. And Infosys files a settlement plea with SEBI over the severance package for former CFO Rajiv Bansal. The company admits that it's failed to disclose details of the severance agreement as required. Those are your top headlines. Up next is Hot Money with Darshan Mehta.
Thank you, Agam. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts for the show. Senthil Manikandan of Newberry Capital, Avinash Gorakshakar of Joindre Capital, he'll join us in a while, and Yogesh Mehta of Motilal Oswal Securities joins us on the show. Thank you so much for joining us on the show. Let's start, and today the stocks that we'll discuss on Hot Money will be counters like Havells, KEC International, KPIT Tech, Maruti and Ajanta Pharma. The first stock is Havells. The counter is up almost 7% from the recent lows. Is the rally here to stay? What's happening with some of the consumer stocks, because companies like Havells are trading near record highs? Yogesh, I'll start with you. You all yesterday only upgraded Havells. That was the note that came out. What's the rationale and what do you make of Havells?
See, Havells is now a total complete electrical behemoth. Now they've started with say only lighting, then fans, then water heaters, air coolers, and then the Lloyd Electric and the standard wire. So Lloyd Electric will provide them a very good growth opportunity in terms of durable segment. Now, if we consider this company as a growth path, GST again, which was a setback for them in first quarter, when the margin were touched all-time low of 10%. But now restocking is happened and they could not pass on the raw material cost and everything to the dealers, and that's why it was been a setback. But now in the second quarter, again, it has returned back to 13.5%, 14%, and we expect that it will come back to normalcy above that 15% from the next quarter onwards. So all these opportunity plus GST rate cut from 20 to 18% in cables and wire. Now this will give a complete advantage for moving towards organized sector, the retail segment and the industry segment both together. So that will provide a good traction for this company on a growth path of cable and wires. So putting all this together summarizes, we think that this is the best play to play on the affordable housing segment, the industrial segment, and total overall electrical and the durable segment. And we have raised target price to 590 as a 35 times December 2019 EPS.
But what happened yesterday all of a sudden? So what was the main rationale for this upgrade? There has to be a trigger for the rationale. So that's what I'm trying to find out.
The trigger was almost we were talking to the management and we wanted to have their outlook on for FY18 as well as FY19 projections. So based on that, we came out the report after that because the post-result we didn't upgrade that. Okay. But during our conversation with the management and a con call, we have revised this.
And you believe that they will be able to turn around Lloyd to their advantage?
Yeah, so far they have done in standard also, and if you see that 16% is a market share in fan, lighting it is a 24% market share, so that gives the edge over competitors.
And you are happy with the valuations of...
The valuation we have comparing is consumer electrical, the peer comparison, so it is also at 35 times, and this is also we are mentioning 35 times.
But overall you are happy?
Yeah, we are happy with that, yes.
What about you, Senthil? Any view on Havells? Do you think that's a good bet?
Yes, so I agree with Yogesh views. Basically, if you see, till last year, Havells has been an electrical and appliance player. With acquisition of layouts, their entry into white goods segment and the market potential for white goods segment is around $17 billion. And if you see Havells, their history, actually they have entered into newer segments from basically cables and wires players into premium fans and further into the appliance segment. So we expect Havells to turn around lights not only in the AC segment but also in the TVs, because so far the lights brand TVs have been selling only in the festival season. So going forward, Havells planning to sell TVs all through the year. So basically on the brand segment also, like they are relaunching their standard brand, and also they are also category into all the segment, mass premium and premium via their corporate segment. So basically put together all these things, I think it's a good play on the consumer electrical segments.
Okay, so it's a 2 thumbs up that's coming in from Havells. Avinash, what do you make of Havells? Both our guests are rather bullish on it. Do you share the same view?
No, I think after the Lloyd's acquisition, I think clearly they get a better product and most importantly a much better headroom to increase their top line. So I would believe that yes, margin expansion as well as top line growth would definitely come in, and although valuations are not cheap, I think they are fair to expensive. I think if one were to take a slightly medium term call over the next say 2 to 3 years, I think in terms of the product mix and in terms of the geographical penetration, I think I would also definitely vouch a positive stance for the stock.
Okay, so that's the positive view that's coming in on Havells. All 3 of our guests have given Havells thumbs up at this point of time. Let's move on to the next stock, and that is KEC International. The stock is up almost 125% this year. Is there more room for the company to grow? And if you look at the Bloomberg consensus, 25 out of the 30 analysts that cover have a buy rating on the counter. So there seems to be a lot of traction here. Avinash, I'll start with you. Any view on KEC International?
No, I think KEC definitely looks very well positioned as far as the power transmission business goes. In fact, they have a very large exposure both in the domestic as well as in the export market. Most importantly, now the railway segment is going to be a key driver for them. In fact, a lot of orders have already materialized, and hopefully in this budget also we expect that big order wins could come in. In terms of the order book visibility, in terms of the margin expansion, and most importantly in terms of the operational kind of margin expansion which we saw in the second quarter, I would believe that yes, again this is a stock which has obviously moved up quite significantly over the last 12 months. But if one were to talk about future growth in terms of earnings growth and the kind of order book inflows, definitely I would buy this stock on a slight decline. But yes, overall prospects definitely seem to be quite good.
But private capex is certainly not happening. So what would make you so bullish? Because obviously the order inflow is there, but on ground orders are not actually flowing in the private, especially in the power space also.
No, in fact this was one point which the management also clarified. I would believe that the first half has obviously been quite challenging. My sense is, Darshan, maybe the December quarter may not see any big inflows from the power sector, but I am quite hopeful that possibly come 2018 we could see a lot of these orders which actually have got materialized up to the L1 stage could possibly materialize into confirmed orders for KEC. So I would believe that it's better to bet on this company, because here the execution has been decent. The order win obviously has taken a lot more time than what the street has expected.
Okay, are you as optimistic, Yogesh, on KEC International?
See, as far as the business is concerned, yes, we are optimistic, and the way the railway is contributing a good traction of 14 billion of orders recently, and they are forthcoming with 2,000 kilometers of railway line electrification already been done. 4,000 will be they will be doing by FY18, and further 8,000 by FY19. So all this put together, SAE is the only where the revenue growth is visible. Plus T&D business is the best one, which is contributing very good to the balance sheet. 65% is the state capex, yes, and 35% would be from PGCIL. So putting all this together, we think that yes, 20% CAGR growth is very much possible. Plus there is a $4 billion worth of order from Brazilian government, okay, and all together is yes well placed, and there is a key dominant player predominantly into power and power sector. So, but on the valuation front, we are not so comfortable because it is richly valued right now. Even if we consider today's price of 330 odd, would be around 17 times December 19, or maybe currently it would be 23 times. Yes. So, based on that, we are a neutral stance. We are not meaning as a sell, but it's a neutral stance.
But it would be a long term. If you are looking at a long term, you would accumulate discount.
Yes, but based on December 19 or maybe FY19, if we consider, then also it is almost 20 times.
So, what would be an ideal valuation on a next year basis?
We would be comfortable around say 16, 17 times 20.
Okay, so that is the thing. Yeah. What about you, Senthil? Any view on KEC International?
Yes, so we are also neutral on the stock, basically because on the valuation concerns.
Okay.
In spite of their order book growing by 30% to 14,000 crores, and with railways capex picking up, basically the 65% of their order book is from the state T&D. So there will be some concerns on the receivable side also. Coupled with that, their debt to equity also around 2x. So if you put together all these points, the stock currently trades around 20 times FY18 valuations. So we are neutral on the stock.
Okay, Avinash, just coming back to KEC International, is this point valid in terms of receivables? Has KEC initially in the recent past had problems with receivables from the government, or that's not a concern for KEC?
No, I think in terms of receivable, Darshan, the timeline definitely has got elongated. But if you were to say that whether there was any bad debt, I would not believe that to happen. So I think, you know, the working capital cycle has got stretched a little further, and that is obviously because receivables have not come in at the right time. But if you look at the overall mix of the business, this has always been the case in this kind of company. And I think, you know, since these are government orders, at least one comfort is that these orders are not going to get bad. So obviously the money will come in, but obviously there's going to be a working capital cost attached to it.
And are you happy with the valuation? You think it's fair? The other two guests do believe it's slightly on the higher side.
See, I think 1 year forward earnings, Darshan, may look a little fair to expensive, but I think this is a company which has got a large order book, and most importantly, you know, the kind of execution skills it has. So I don't think there's going to be any major panic sell-off or a big correction where possibly one could get it at a mouth-watering valuation. So I would believe that, you know, if 17-18 times is expensive, at best I think it could come down to 15-16 times, and that too in case, you know, the market corrects significantly. Otherwise, I mean, I don't think there's going to be any cause of concern for the stock to actually correct. Valuations may not move down significantly and go up also. So probably take a 2 year plus view, and that would be definitely be a worthwhile kind of wait for this kind of company.
Okay, so that's the view that's coming in on KEC International. Avinash is extremely bullish on the counter. Other two guests are not negative on the counter. They believe that valuation is slightly expensive. They would wait for a slight correction before accumulating. They are not negative on the counter. They like the business. That's the view that's coming in on KEC International. The next stock is KPIT Tech. Was one of the best F&O gainers yesterday. The counters recovered almost 50% from the recent lows. Is there more room for the counter to grow? Are we seeing significant amount of traction more on the mid-cap IT rather than the large-cap IT? So is the trade shifting to that side is something we'll ask our guest. Senthil, I'll start with you. Any view on KPIT and any view on mid-cap IT as a pack?
So we are neutral on the stock. Basically because if you see KPIT caters to traditionally 5 important segments, that is automotive, and then the engineering segment, and then the energy segment. If you see, the automotive segment is powering the company. Like last 3 quarters, 20-25% growth is from the automotive segment, while the other 2 segments are lagging behind. And also if you look at their service lines, their SAP and their IES are bit lacking because of the traditional IT systems which are facing troubles because of the transformation that the entire IT industry is going. And within the mid-cap IT space, companies which are focused on niche like Persistence, which is into product development, or if you compare Take Solutions, which is into life science segment. So these are companies which will be like we are favoring these companies because they are not affected by the transformation wave that is going on in the IT sector. And if you look at traditional IT systems, I think the large cap players has a better performance compared to the mid cap traditional players.
Okay, Yogesh, if I'm looking at the companies, the brokerages that cover, I think you all are one of the companies which have a very bullish target of 160 among the top 3 as far as, because Anand Rathi is 190, Maybank is 170, and you all have a target of 160. What do you make of this? Any reason for a slight bullish tone on this one?
It is a neutral stance, okay. And even on the fair valuation type, even if you see that visibility of growth is still not there, though they have come back after 2 years of negative growth. Now the first quarter was there, so visibility needs to be there and sustainability needs to be there for upgradation of the stock or the company's revenue growth. So we are waiting for that. If it happens, then we may change it, but right now we are making a neutral stance because when we spoke to the management or maybe a Q2 earning con call, they mentioned that 12% they are expecting 12% growth for FY18.
Okay.
Now first of all, they have done some investments for revamping their products, and as Senthil mentioned, that automotive and transportation is the biggest revenue contributor for them, and US was 5.5 to 6% growth rate. What we believe is that they have done a significant hiring last year, FY17, that's why it was dampened and they got hit in the profitability. So this year around, they have cut down in the second quarter, they have cut down by 350.
Okay.
So almost they are working on it, but on the fair valuation side, even if we give a 10 times P multiple, it is 160 FY19 based of EPS. So there we are keeping a neutral stance for KPIT. So we need to have some more sustainable traction of growth.
Okay, so last 1 or 2 quarters results were good, but you need to see more of that coming in. And as a house, what are you all pushing? Large cap IT or mid cap IT? Where seems to be, where is the flavor right now? That's the sense I wanted to get.
Yeah, so Darshan, on the IT space, if we consider the sector itself, then on the larger side, we are Tech Mahindra, we like most after Infy, of course. And on the mid cap segment, we have upgraded recently Mindtree. So, but again, 600 is the price target we have objective of, but right now it is 550
I'm asking where are you seeing more traction among the I'm just take a pick between not stock specific, but are you seeing more traction going ahead in the large cap IT or the mid cap IT?
The mid cap IT.
The mid cap IT, you see more traction.
We see more growth.
Okay, Avinash, any view on KPIT Tech? Do you think there's more room for the company to grow?
I think I agree to Yogesh that I think after the second quarter, the management clearly pointed out that Q3 could be a flat quarter, although they are very hopeful that the second half will be a much better quarter. I think in terms of automotive and the digital kind of transformation business, I think the company is definitely hopeful that they could be getting in businesses from new verticals. So I would believe that I think the downside for the stock is not very large, but obviously if there's a positive surprise in the fourth quarter and hopefully FY19 is much better, then I think the stock trades at below roughly about 10 times FY19. So some positive surprise coming in from the new business verticals plus the margins remaining more or less at the same levels could be a kind of a re-rating trigger. This is definitely not a stock which I think probably is going to go down, but over the say next 12 to 18 months some positive surprises coming from the new verticals, we could see a gradual re-rating. So I would definitely be positive. These levels I don't think are so expensive that they would probably say that it's grossly expensive. So I would put my money say over the next 12 to 18 months and try to actually believe what the management is saying, that probably new verticals would give in a better picture for margin as well as top line.
Okay, so that's the view that's coming in on KPIT. Avinash again is rather bullish on the counter, but a more neutral view that's coming in on the stock from Yogesh as well as Senthil. And as a house, so Yogesh believes that there's more traction that mid-cap IT is seeing. So a lot of mid-cap IT stocks is something that you need to watch out for. Here's a quick recap of all the guest stocks, on the guest views on the stocks that we've covered before we move on to the next stock. Okay, the next stock that we'll talk about is the big boy of the auto space, and that is Maruti. Stock trading at fresh lifetime high. Is 10,000 a possibility for Maruti? We'll ask our guest. And interestingly, I was looking at it, out of the 54 analysts that cover Maruti, there are 42 which have a buy, 11 a hold, and just 1 sell on the counter. So that actually proves where the consensus is. But let's ask our guests what they believe. Avinash, Maruti, 10,000 possible?
Yeah, definitely. In fact, Darshan, this is not a trading stock, and according to us, I think any dip in Maruti, should be considered as a kind of a good buying opportunity. This has been one stock which has actually given very few, opportunities. I remember when the plant problem started, the stock actually had touched a new low, but then I think the way they recovered from their problem and the kind of product bouquet which they hold, I would believe that even now with the electric vehicle, news flow being in buzz, this is one company which has already now started doing a lot of work on that, and hopefully by FY20, the management is hopeful that their alliance with Toyota would obviously show some results. So overall, I think this is definitely a stock which is a long-term portfolio stock, not a trading stock, and I would believe that even if one were to say that valuations may look a little expensive, they have a very large market share and a great amount of pricing power for their products. So all said and done, this definitely would find a place in my portfolio, maybe on a decline, but longer term definitely there's a lot of earnings growth and a lot of risk reward which can even come from the current.
So you're saying that you would place more emphasis on growth over valuation for Maruti?
Exactly. I think this is one stock which is a prima facie representative of a sector, and which most of the FIs, the local institutions, would definitely not like to miss out. This is not a typical mid-cap stock which is illiquid. I mean, clearly valuations are expensive, but the business also holds a tremendous opportunity to scale up in the next say 2 to 3 years.
Any concerns on Maruti?
I would believe that, I think earlier the JV for the Gujarat unit had a little bit of noise, but I think that has now cooled off. So I think markets would now obviously look at how they probably, manage the scale-up opportunity. On the electric vehicle business, as of now, the management has said that whatever happens, it will happen in the parent company, I mean in the domestic company.
Okay. So what about you, Senthil? A bullish view here? Do you have a bullish view, or you have something else on?
So we have a contrary view on the stock. Basically, if you look at the US market, Tesla is making losses, but the company's market cap is around more than 45 billions. While if you look at the Ford and General Motors, they are trading at single-digit PEs, and their dividend yield is more than 4-5%. And if you come back to our Indian market, Maruti is entirely into internal combustion engines, and going forward, there is a lot of consensus that electric vehicle is going to take over. And Maruti, if you look at the valuations, it is trading at around 30 times FY19 earnings. And if you look at the being the market leader in India, Maruti should be the front runner in taking the next technological step. Instead, what you are saying is Tata Motors and M&M, they are foraying into electric vehicle space, and recently we saw yesterday Tata Motors launching their EV Tigor. And if you look at the M&M, Mahindra Electric, they have planned for a 600 crores of expansion in the electric vehicle space, and they have currently 4 products already in the market. So what you are saying is that traditionally, if you look at the in the market, when the technology changes, it's always the incumbent who loses. So we expect Maruti to be being a major incumbent, and the current valuation also doesn't offer any comfort. And as you said, the consensus is like Maruti will ride over this electric vehicle disruption. So we are not favor of the stock at current position. Okay,
Yogesh, firstly your view on Maruti, and is that a valid concern on what Senthil said?
I completely do not agree with Senthil at all, where I completely agree with Avinash. Now, disruption is still 3.5 years away, and that too it is not on a large scale. It will be just a startup. So right now, at the current situation, what we see is that on the second quarter numbers, Maruti was able to gain their market share by 2.5 percentage point more. So now it is above 50%. Secondly, first-time buyer, if you see the disruption in the electrical vehicle we are awaiting for. So first-time buyer has gone up by almost 48 to 50%. So that shows the popularity of the model in Indian affordable car segment. Petrol variant is also improving 25% YOY. The growth, which was 1,15,000 for last year every month sales, now it has reached to 1,50,000 base case scenario. So that is showing that 20% growth is 20-25% growth over EPS will also happen there. The other thing is Gujarat plant, which is 24,000 units for first quarter. Now it has gone up to 34. It will go up to 48 in the next quarter. So this will give a traction, and whatever the demand is there, and the Nexa, which is providing cushion to the profitability, which we see that from where the growth will come. So they have identified Nexa, wherein the commission level to the dealer level has cut down and gone to their own pockets. Bolero, Desire, Brezza, everything has gone up. The waiting period is still there by varying from 2 to 4 weeks. So putting all this together in the demand, the disruption in electrical vehicle is still far away from 2020, and management is not is accepting that yes, it is there and they are working on it. So it will take time. Now compared to the global automobile companies, there is nothing like there is a competition is into them itself, and nobody is making money, kind of that. Wherein if we see Maruti or if we see Tata Motors is only the losing one, M&M is earning into the profitability for this segment. Maruti is earning, so is other companies which are not listed. But so we need not compare right now in the global platform. We are not at that large scale like pharmaceutical sector is. So at present, for next 2 to 3 years, level playing field, we have to compare on the domestic market itself. So we are projecting, we are rather upgraded our price target from 9,466 to 9,866 based on 25 times September 2019 earning, and there is a cash per share of 1,471 on the balance sheet.
Okay.
So we are very much bullish on automobile four-wheeler.
I think I would like to add that Maruti has said that Gujarat facility will even make lithium batteries. So I think they are very pretty serious on the electric vehicle strategy, and I think I agree that eventually in a market like India, you require infrastructure to be positioned very well on the ground before we see those big volumes. So at least 3 to 4 years before we see a decent contribution from the electric vehicles. Till that time, I don't think you're going to see a sudden shrinkage in demand for the international, IC engine kind of business. So I think it's a scare which people have propagated. Even the vendors have, spoken to us. They've said that this is just some news flow. I don't think it's going to actually impact FY19 or FY20 or maybe FY21 earnings.
Okay, so that's the view that's coming in on Maruti. Two of our guests, Avinash and Yogesh, are extremely bullish on Maruti. A little bit of concern because of valuation and the electric vehicle foray which is happening by other companies is something that Senthil put forward. He is not bullish on Maruti. And the final stock is Ajanta Pharma. As all pharma companies, even Ajanta has faced a lot of weakness. It's down almost 30% from the all-time high. Not as bad as some of the other pharma companies have done, but now valuations are at 20 times next year, which pretty much puts it in the middle of the mid to the large cap pharma space. So is the recovery possible? Are valuations at this point of time attractive? I'll start with you, Yogesh. You're also one of the most bullish brokerages on Ajanta. What do you make of it?
See, post second quarter numbers, we believe that US market are still struggling towards, but South Africa and Africa market is doing very well. We have seen this is on a larger base because US market is very thin for them. It is around 260 million of sales on a quarterly basis, whereas Africa is 2.5 to 4 billion. So there they are growing by 26%. Here they are sluggish by 63%. But institutional anti-malaria segment, which is providing a great cushion. Yes. Even first half they've launched some 5 ANDAs and 7 are in the pipeline. Now Python facility is now running with full capacity, and the Dahej one, the next pipeline would be from the Dahej. So we believe that yes, strong traction is there in terms of visibility for the new product launches and new ANDAs launches, plus there is no issue of US 483 at all. So this company, we think that yes, with a higher ROE and ROC 26% plus, that provides a cushion to us, and right now it is at 19 times FY19. But upside, we are not seeing that it will be a doubler one, but yeah, 15-20% kind of a return can be generated from the current price. Okay,
what about you, Senthil? Any view on Ajanta Pharma? Do you share the same bullish view?
Yes, I agree with Yogesh views. If you look at Ajanta Pharma, they are operating in 4 geographies. Basically, India and Asia has been a steady performance for them in the last 5 years. And US has been a bit lag off, but considering the pipeline, they have around 22 ANDAs. They are planning to file around 12 to 15 this year. And if you look at African market, management has guided for a 12 to 15% downturn in this year, basically because of the slowdown in the allocation for the global fund. But if you look at if you compare Ajanta Pharma with all other pharma companies, because of their steady performance in the domestic formulations market and their inflow into the African market, in the last 5 years, their performance has been like the stock has given almost 11x, while compared to the market leaders, like they have grown by 20 to 40%. So clearly, the stock with ROE of more than 30%, and it's trading at around 20 times its 1 year forward earnings. Clearly, it can give 20% returns going forward.
Okay, Avinash, your final view on Ajanta Pharma?
No, I think, Darshan, I think clearly if you look at the business model, they operate in a niche market. I think operating margins of 34-35% is very strong. And I think as Yogesh pointed out, the Dahej facility is now going to be the near-term trigger. I think US market will open up a big opportunity for them. We may have to wait for FY19 second half or FY20, but I think if the execution works out well and if the product launches are on time, I think we could see a better kind of margin as well as a top line picture there. So I would say that even if it trades at a fairly reasonable to expensive valuation based on FY19, I think growth momentum is going to continue. And I think in the domestic formulation market, they have a very strong edge where they control almost 105 to 110 odd formulation branded products. So growth is going to come in. Maybe for the near term, the stock could consolidate, but over the next say 2 years, this could be a good entry point for somebody who's looking at a 25-30% CAGR.
Okay, so that's a consensus bullish view that's coming in on Ajanta Pharma, given the fact that return ratios are extremely strong and the outlook looks extremely strong. Before we wrap up on the show, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, Avinash, Yogesh, Senthil, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.